This is Scott here, co-founder of HiYield at XYZ. We offer leveraged returns against the industry's top real-world assets through the high-yield lending market. And I'll turn it over to the guys at Resonate to do a brief intro and talk a bit more about their product, and we can just get going from there.
I'm Kirk, the head of partnerships and ecosystem growth for Revest/Resonate. To clarify the difference between the two real quick. So Revest is our NFT tokenization engine. And then Resonate is our yield futures platform that kind of utilizes the NFTs to facilitate the yield swaps is the simplest way I can put it, but I'm sure we'll get into that a little bit more. But yeah, super happy to be here. Thanks for having us on, and I'll pass it over to Taylor.
We basically do the same thing. I work on the BD side of things, building relationships with other protocols like HiYield, and also helping on the institutional side as well, and onboard institutional capital onto Resonate. So yeah, super happy to be here.
Thanks for joining, guys. I think a good place to start, maybe just giving a high-level overview of Resonate, I think makes the most sense to maybe focus on, since it is a more tangible use case of Revest underlying tech.
So basically, Resonate take the underlying Revest FNFT technology, and we use it to basically allow for any yield-bearing asset to be locked up and to use our FNFTs to split the principal from the yield component. And that lets us do a lot of cool stuff. And one of those things is allowing for somebody to be able to sell their future yield for an upfront payment now. And so really up to this point, or like starting a couple of months back, we were doing mostly volatile DeFi asset stuff. So basically fixed rates on things like GLP or Frax ETH or, some other things, Curve USD and others. And the idea was basically to facilitate an upfront payout to let somebody basically hedge against volatile interest rates. That was the vertical for a long time. And I would say a couple months back, we've made a pivot towards this RWA sector, which is experiencing this insane explosive growth. And I don't know how much we can say about exactly what we'll be doing, but I think we can say that we're not totally going to move away, but for now, our focus is going to be on doing some of this upfront fixed interest rate, upfront payment stuff, or this present value stuff, but on RWA assets. So I hope that's a good kind of intro where we're at.
Yeah, definitely. I think let's take what you just said and apply it to a tangible example with something that HiYield could offer. When we go to market, we'll be having a specific T-bill product. So there'll be a specific bond that matures at a specific day with a fixed interest rate. Let's say it's a 1-year treasury bond, just for an example. It's yielding 10%. Again, just an example. How would that work if we work with you guys? It's going to mature in 1 year. Let's say I have $100 worth of principal and it's 10% yielding product. So how would a user, someone who purchased this asset from HiYield, how would they use Resonate, and what kind of problem are you solving for them? What kind of value do you bring for that user?
Yeah. So somebody who's got $100 worth of this, basically something like a receipt token for some underlying RWA asset that's being custodied off chain, they could take that $100 to Resonate and lock that up basically into escrow. And they would basically sell their rights to their future yield on that position. So as you said, that's $10 after 1 year. Somebody might be willing to give them, say, $7 or $8 on that $100 now, right? And the cool thing about that for somebody taking that trade is when they get that upfront yield, they can then go use that anywhere else in, say, DeFi, or they could take it off chain and use it anywhere they like. But one of the things they could do is get digital asset exposure to say a more volatile asset that comes with more risk. And they could do so while only ever risking their yield. And meanwhile, their principal is protected. So this gives them an opportunity to basically juice rates on something, say, like T-bills or bonds without ever having to risk that underlying principal. But they still can get that upside exposure, that risk exposure that they're looking for. So that would be one basic example.
Yeah, so the user experience, they would start with 100 USDC. They come to HiYield. They buy $100 worth of a high-yield treasury bond that matures in 1 year. And then they would take that token that they receive, they would lock it in Resonate, and they would receive $8 today and $100 back a year from now, right?
Correct.
Then the next thing you say to yourself is that the user then needs to turn that $8 into more than 10 for this trade to be worth it. Is that a fair understanding of return profile of using Resonate? You have the interest up front, so you need to go then and try and turn that into more than the original interest by the time of maturity.
Yeah, you could think about it that way. And certainly that's going to be the goal for, say, a hedge fund, right? They're going to want to make up for that opportunity cost, and kind of what they're giving up to obviously get liquid right now, on some of that yield. But if you take into consideration some other users, it might not be about going and outperforming the rate that you just gave up. It might just be a simple hey, I need cash now, whatever various reason, whether that's to fund program to help the growth of my protocol or my chain or whatever it may be. So So there's definitely a use case for different specific users. Some are going to want to go and outperform that rate, and then others are just going to be happy that they got their yield now. So it's a little bit different per user. But yeah, certainly there's going to be a lot of people that are going to want to go out into the market and try to outperform. And they can do that now with, making sure that their principal's locked up and it's not at risk, and they're only kind of playing with house money at that point.
Got it. That makes sense. Do you guys only do public market securities as the plan, or would you do this for a product like, a Maple Finance deal or a Credix deal or, Goldfinch?
It can apply to a range of assets. I think we're going to start with some of the more traditional RWAs. We're kind of seeing come on chain that there's certainly an appetite for, but there's going to be a market as well for the more private debt instruments, right, that are higher yielding, but also carry a little bit more risk. But it's not limited. The beauty about the Revest and the Resonate system is it's pretty flexible. We can integrate a lot of different assets.
Yep. But who decides how much of the interest is going to be paid up front for a treasury bond deal?
Yeah.
Paying a certain amount up front? That's pretty straightforward. It's globally renowned as the risk-free rate. You can assume with most certainty that you're getting it. You're going to get that interest a year from now. But what about a Maple Finance deal or Goldfinch Credits, these private credit deals?
This is Rob, by the way. Joining this Twitter Spaces has been quite interesting. I know we've had some question of whether I'd be able to make it or not. I'm Rob. I'm the CEO and founder of Revest and Resonate. I'm currently at the RWA Summit in New York City. So that's where the sound is coming from. To answer that question that you just asked, yeah. So we have a discount that is set basically the same way that discounts are set for something like Aave. It's going to be set by third party who can take a look at the market, evaluate, okay, what should the discount be based on supply, based on demand. But then in terms of being able to know what a certain asset is going to produce, even when you're talking about private credit opportunities, as long as they're structured as fixed income products, that is to say, they have a payback period with a schedule of expected paybacks, you can structure them under our system. Now, granted, you cannot guarantee that there is not going to be a risk of default. And for that, we expect a higher spread on these payments just to compensate for that risk. That all said, it's not very all that much different from valuing a U.S. Treasury and determining what the future return on that is going to be, given that is a known factor.
Got it. Yep, that makes sense. And then you mentioned that the types of products you do as fixed income specifically, do you guys do for perpetual products or do assets with a duration? Is that kind of a mandatory requirement? I mean, just to be on the same page, high yield assets, all of our primary asset issuances will have a duration, specific maturity day where principal and interest is repaid. They're all kind of deferred interest payments until principal and interest are all both repaid at the same time at maturity. Is that mandatory for you guys? Or do you also do perpetual products like something like Open Eden, T-bill vault, for example?
We can do perpetual. We actually far prefer the model that you are operating under because it matches the real world closer. And our ultimate angle of this is it has to do not just with people who are already in DeFi. I will leave it at that. There is a sort of access that these assets provide that doesn't otherwise exist and that we are going to be able to provide through our system. So I'll say, for that reason, being able to offer duration-based known return assets is much our preference, because when you're talking about these larger players, they already have portfolios. They have an idea of what percentage they want of 3-month, 1 month, 6-month bills, and they have a very specific set that they would like to have. When we're offering these products, we want to be able to best match existing solutions rather than having to offer these perpetual ETF-based systems that have become. So yeah, I actually far prefer duration-based guaranteed return assets when I'm talking about tokenized treasuries and the services you tokenize.
Nice, yeah, definitely on the same page there. The reason that we pick fixed duration assets is to have these kind of guaranteed liquidity events. We target short duration, 9 months or less. There's also more favorable regulatory structure for fixed income offerings like that. I guess to kind of shift gears a little bit here, what would you say for you guys gets you most excited about the RWA space? What are you kind of looking forward to most in terms of tokenized assets? I mean, everybody is talking about T-bills right now. I think that's kind of expected given what the Fed has been doing, continuing to raise rates. It becomes a really attractive asset. But as things balance out, let's say 6 to 12 months from now, what do you guys see as being the most popular asset class?
We'll likely trend back toward more corporate debt and private credit markets. To me, though, all of that is secondary to what these assets represent, which, like I said, is a route into this space that nobody else sees, but that we do see. There's a really big problem right now with institutional access to our world. And what we have here, what we have figured out, it is the solution to that problem of access.
Can you elaborate on that a bit? What problem are you addressing here that enables more institutional interest in these products?
Well, to put it quite simply, if you're an institution, holding these real-world assets is your only path compliantly into decentralized finance. And being able to risklessly take the future return of that asset and deploy that into decentralized finance positions is the only way that you can ever participate while satisfying your legal requirements in DeFi. That's all the alpha I'm going to drop. That's already probably too much.
All right, fair enough. So
yeah, don't give away too much here, Rob. We've been trying to keep some of this close to the chest.
All right.
Up until
I'll save it for our next call then. I guess another question that came to mind, you were talking about riskless returns. Like if the asset defaults, who ultimately is on the hook for that? If there's no interest that gets paid, right? You guys underwrite private credit deal, let's say, and then there's 100% default, just like what happened on the Tagunde Kenya deal through Goldfinch recently. How would you guys handle that? And is that something that your institutional relationships are okay with being a possibility?
That's why we're focused mainly on treasuries at this point. Their massive security and their extremely low risk of default. But in that case, if we were talking about private credit opportunities, say funded by a private equity guy who wants to take on that level of risk, well, if you have purchased the rights to the cash flow on that asset and that asset defaults, you're not going to get the cash flow. That's unfortunately the way. But when you're talking about assets that have a default risk, you need to know what you're getting into. And that's why this entire product offering is primarily aimed at institutional participants, because they have extremely well-developed risk underwriting system.
When you guys add a new deal to your platform, like let's say we wanted to work together on Maple Finance deal or something, or you were working with Maple holders, you would need to do kind of custom work on the underlying risk to decide how much you would offer on the future interest payments. Higher level question, you want to add a new product? What's the process there?
Well, we're not going to do the underwriting ourselves. We're going to make sure that it is KYC, AML compliant to the level that we need before we offer to any of our institutional partners. And then we're just going to gauge demand, and if demand exists, list it. In terms of actually looking into the risk, the best we can do is offer, a fairly basic overview of what the product is through our fund. It's up to our users to decide who they want to work with and what assets they want to work with. Because at the end of the day, we're operating as a peer-to-peer lending market in this sense.
Okay, got it. So the individual institutional relationship that you have, those guys would be the ones underwriting and making the decision there. So you would need them to go through the underwriting process before listing a new asset.
There's three parties. There's the tokenizer, there's the receiver, and there's the payer. The receiver is the one who is owning the asset and is bringing it to our system. And that's someone who's either purchased that asset and wants to offload, say, the risk of a private credit deal, assuming that they can guarantee they'll get the principal back. And somebody who wants to underwrite that cash flow is the payer. So it is up to those two to choose, the asset class they want to work in. If they're comfortable working in higher risk assets, then you'll find support for those sorts of products. If not, then they may stick to more treasury-based systems. At the onset, we're focusing solely on treasuries just because we're all too well aware that things like Goldfinch's recent default have less than a bad taste in people's mouths. So that's really driving us toward assets with the lowest risk and relatively low rates of return, but the scale that we're seeking to operate, that's negligible.
Okay, got it. So in terms of trying to find ways to work together, it sounds like you guys would be most interested in treasury bills, AAA rated corporate bonds, like AAA rated asset-backed securities. Is that fair to say?
Accurate, entirely accurate.
All right, so as we're trying to, source demand for high yield primary issuances, I think that's definitely something we'll keep in mind.
Our target customer already has a fixed income portfolio. Ideally, if you know any insurance companies, well, we're very interested in talking with them.
Okay, all right.
Especially on chain.
Strong fixed income portfolios for insurance companies, definitely.
Exactly.
Okay, so you guys are looking for people who already have a fixed income portfolio. What High Yield is trying to do is get more folks on chain to build their own fixed income portfolios, and then kind of use Revest to sell some of their future interest if they're interested, if they're trying to get some instant liquidity on that asset.
Wait, have we told people any details on launch on your end, or
no,
where we're all building together?
Yeah, I guess, yeah,
okay.
You can find both of our products on Avalanche, definitely before end of year. Hope I'm not speaking out of turn for you guys, but
No. That there's some alpha.
Okay. All right. Yep.
I wonder why we're doing that.
Yeah.
Who knows?
Definitely excited to be working together, providing liquidity to the real world asset space.
Yeah, it's
100%.
it's definitely a good place to be building right now.
Yep. So, all right. Make sure to follow HiYield, Revest, Resonate, all these guys that are speaking here. Thanks, everybody, for joining. Really appreciate Revest, Resonate guys hopping on today, especially Rob while at the RWA Summit.
Likewise.
Look forward to working together. Take it easy, guys.
All right, Scott. Great chatting with you,
Yep.
Scott.
See ya.
Catch y'all later. Bye-bye.
Later, everybody.